fixed rate mortgage for the next 2 to 4 years, you don't have to worry about this. Everything's good. Reach out to me in a few years when you get some sticker shock as to how much your interest rate and mortgage payment has increased, and we can deal with that then. But you're in a great spot right now. This video is purely based on a conversation with those who currently are in a variable rate, or your mortgage is currently up for renewal. It's coming up for renewal in the next 4 months, and you were trying to figure out what the heck you're going to do. And for the majority of you, your first impulse is going to say, I would not even consider a variable rate mortgage right now. You are crazy. You're out to lunch. That does not make any sense. At top level, that feels like the right thing to do, because the biggest problem right now, when you look at the 5-year bond yield, looking at what things are doing, we had another massive spike just in the last couple days here. Things jumped up exponentially, another quarter point, which means in the next week, it's October 20th, 2022. So in the next week, you're going to see 5-year fixed rates go from high 4% to now high 5%, some banks even 6%. And we're thinking that's crazy. We're thinking, my goodness, we haven't seen rates like that in a quarter century. So how do we navigate that? Why, if I'm having a renewal mortgage, what am I doing? Am I going to get a 5-year fixed that's 5 or 6%? Why would I do that? But then on the flip side, October 26th, in 6 days from now, the Bank of Canada is going to make another rate increase announcement. And I am not going to sugarcoat this. In September, inflation did not come down as they were hoping. And I'm talking core inflation. I'm not talking total inflation. The cost of fuel really screws everything up in that total equation, and it makes it very confusing, the data, for people to realize what actually happened, because fuel was like this, then it came down, then it went back up. I'm talking core inflation. It didn't come out as good as we were hoping. Meaning, combined with that is the United States. Their interest rates are getting out of control. They're already sitting at 7, 8, 9% for 30-year terms. Unlike Canada, where we typically do 5-year terms, the US is very different. They will have a locked-in rate for a quarter century. So imagine trying to get a mortgage right now at 7 or 8% for the remainder of your life. Anyways, different rules, different place to be nonetheless. But anyways, Canada's affected by this. And so when you're thinking about, okay, I'm going to go into a fixed rate at 5.5%, or I'm going to be going into a variable rate, but these rates keep going up, why would I do that? Okay. And the simple answer right now is there's no right answer for anybody. Nobody can tell you what you should do, because just like we learned from the pandemic, just when we think we have everything figured out, everything goes sideways. So, but what I hope this video helps you in your decision in making this, if number one, your mortgage is up for renewal right now, and number two, if you're just wanting to, jump off a bridge because your variable rate is so crazy, you want to put it in a fixed rate. These are the things you need to consider in that massive decision. Okay, is number one, the prediction, take this with a grain of salt, is that there is a recession that's going to be coming. And when you look at the history, you look at the trend of recessions in Canada, this is just a basic history of recessions based on their category. So 1 to 5, back to the Great Depression in the 20s, being very significant recessions, all the way up to 2008 was our last true recession that carried on till May 2009, category 4, not as bad, but significant. These recessions, they trend, sorry, what I'm trying to say there is that you can't predict a recession other than when it's inevitable. And what I mean by that is that no matter what the government thinks they're going to do, there's no such thing as a soft landing from this. Okay, well, so never in the history of the economy has the Canadian government ever been able to do a soft landing, like they keep talking about in the media, right? So this soft landing, they're trying to get this soft landing, increasing inflation to cool down the market, right? But let's make no mistake, that has never happened. There's never been a soft landing, meaning that inflation, if it gets too far out of control, the only way to trigger or cool down inflation is to increase rates. which is exactly what's happening right now. And so with those rate increases, we have to accept the fact that rate increases decrease inflation. And the only way inflation decreases is based on the fact that it discourages spending. Okay. And the government has been very clear about this. You go on their Twitter page, they have flat out said, look, we have to discourage people from spending money. Flat out. Meaning you can't go to IKEA anymore, buy your furniture. You can't go and buy the extra things that we were doing for the last couple of years. They want you to stop spending money, because in order for you to stop spending money, that will encourage deflation. Meaning we're so far away from deflation at this point, but that will allow the inflation to cool down to a point that brings things back into a balanced economy. Okay. But going to that whole history of the recession histories is any time that they have tried to cool inflation, they have triggered a recession. It is inevitable. There's no way they will find a sweet spot. If they do, and I hope I'm wrong, then this video is completely useless. But I am basing this on history and basing on pure statistics as how this works. When you look at how an economy and a business cycle works, it shows right here on this Canadian Encyclopedia website, right? You have expansion and contraction. A business is super booming. Things are good. Things are crazy. Look what's happened for the last 2 years in the pandemic. The government was like, yo, let's drop the interest rates so low, we increase and encourage spending. What did people do? They had low interest rates. They lit a gas fire on the prices of houses. They encouraged spending. People bought these very overpriced homes in connection with all the things they put inside those homes, plus renovations, plus. And all these other businesses were affected by it. So when people bought all these things, then all these other things were expanding, okay? But now we're going into a contraction. And this is just how it is. This is how this works in this cycle. And so there is never an opportunity to find a perfect balance. It just seems impossible for the government to be able to do that. There is no such thing as a soft landing, as I keep saying. So what I'm saying is, going back to the variable and fixed rate terms, is the prediction from most people that have been in this industry for long enough to see what's going on is that the recession is coming. And the simple answer is it's predicted in the next 1.5 to 2 years, meaning you're going to see rate increases this fall again, just when you think it's over. In 6 days from now, I am confident we're going to see a 0.5 to maybe even a 1% rate increase, probably 0.75. Then it's going to happen again in the spring. And by then, we're going to start seeing how people finally react to where this is actually going, because we've already seen in the last 2 and 3 months how much these rate increases have dramatically turn off the lights for a lot of businesses, in the sense that it's starting to happen. But that's just the beginning part of it. And these cycles take time. And so what we have to realize is that the recession is inevitable, but it's not going to happen overnight. But when that recession happens, you look at the trend of these recessions, okay? Through this recession ended in May 2009. You go back to the bond yield. All right, let's go back to 2010 and 2008 here. You go back to May 2009. Okay, interesting. Look what happened here. May 2009, what would happen to the bond yield? It dropped, meaning fixed rates went back down. Okay, let's go back even further here. May 1990 to 1992. So let's go back. I don't even know if this will allow me to go that far back. But when you look at the last recession from 2001, look at the drop in the trend based on that, okay? I had some other data here I could show you in the bond yield going even further back than that, which I'll pop up here later on in my rant. But anyways, my point is, anytime there is a recession, bond yields drop. The fixed rates go down, and pricing, because the only way to fix a recession is the opposite of inflation. So recession means we have to encourage spending, and the only way to encourage spending is if rates go back down. The problem that happened in this pandemic was it wasn't a true recession, okay? Essentially, we had this like synthetic recession. It was like a fake recession where people just turned off the lights for a few weeks because of COVID, and nobody really knew what was going on. Yeah, we panicked in March and April and May of 2020, and we were trying to navigate what was happening. But the problem is the government reacted so fast in this transition, which I'm not discrediting or crediting him this, they reacted so fast, they lit a gas fire on it so quickly, it kept things going. Okay. Now, I'm not talking to everybody. Okay. I know restaurants struggled. I know there's service sectors that got obliterated, and we feel terrible for those industries. I'm talking in general. They had to do what they had to do to encourage spending. And look what happened to interest rates. They went back down. Okay. So it was like it wasn't a recession because things kept going. But what I'm saying is that's the trigger of that momentum of what can happen. And where we are right now is that happened so hard, so fast, which I've been telling all of my clients since they've been buying the house for the last 3 years. They have to get ready for this. And I have said this to every single variable client that I've ever had, that they have to recognize there is risk in getting a variable rate, because in the last 10 years, there's been no risk in getting a variable rate. And now people are looking for an enemy to point the finger at. And whether it's the government or their mortgage advisor or somebody else who told them that this was a good idea, at the end of the day, we have to own the decisions we've made. So what we have to do then moving forward here is decide, what should you do? Should you get into a fixed rate now and bite the bullet, or wait for the recession in a year and a half to come where fixed rates could come back down? Now, to also answer that question deeper, I want to clarify, when I say a recession is coming, I don't think it's going to be a recession in the sense that we saw in a way that we're ever going to see interest rates at 1 or 2% again. So if you're thinking, I'll just wait, keeping this variable rate 5, 6, 7% coming down the pipe, but I'm going to get 1% again, I think you're living a pipe dream. I think if you just simply purely look at the bond yield for the last 25 years, the bond yield was at 6% back in 2001. Look at the last 10 years. It's ridiculous. Rates have been below 3% since 2011. For 10 years, we have not seen interest rates. They just crept up to barely 4% in 2013. So what I'm saying is our generation, this decade, has never seen typical interest rates. So that's the other part I want to add to this decision that you make, is be prepared for a healthy interest rate market, meaning you're probably going to say goodbye to the good old days where, like in countries like Japan and Sweden, they had negative interest rates. We had rates so low that we have fixed clients at 1.2% at one point. It's crazy, but those days are gone. What I'm saying is, if you hold tight for the next period of time, you are probably looking at maybe 3 or 4, maybe even 5% is going to be where the fixed rates, where the dust settles for the next 3 to 7 years, as the prediction from what people are saying, once the recession hits. So the begging question comes down to, do you get into a fixed rate right now at 5-ish%? That's where things are, and be okay with that. And that's just where your mortgage is, and that's just where we're at. Now, one thing I want to add to that layer too is that people neglect to think about is you're scared, or we're concerned about affordability, and like, man, I can't believe rates are at 5%. This is crazy. One thing we need to remind you of is we had this little thing called the stress test back in 2017, which everyone criticizes from the Bank of Bank of Canada, which I can flat out tell you was brilliant. I supported it 100% because it absolutely made sense to bring the market to value. So there's going to be critics on both sides of that. But anyways, since that 5 years ago, believe it or not, your mortgage has been stress tested, meaning the minimum was always 2% above the current rate that you had. So if your rate was 3%, you were stress tested at 5%. Now, there's some caveats to that, and the simple equation in recent times was, even if your rate was less than 2%, so let's say your rate was 1.5 or 2%, the minimum stress test was 5.25%. Okay, that's how we always equated for the majority of them. Now, what's changed now is we're past that. We're way past the stress test of the minimum of 5.25. So people are getting mortgage rates right now at 4.25, 4.75, 5%. So you add 2% to those rates because it's past the 5.25. But what I'm talking is for people renewing their mortgage, okay, or you're in a variable rate right now, and you're floating at that 4, you're floating at that 5%, and you're saying, I'm sick to my stomach. I can't believe I have to lock in this rate. How am I going to afford this? Well, the simple answer is you are going to afford it, because your mortgage was originally qualified at that. Meaning, whenever you got refinanced or renewed or transferred or purchased in the last few years, you were calculated on your gross income ratio to the debt load, and you checked the box at 5.25%. So even if your rate was 1, 2, or 3%, you were still simulated in these current rate environments. So what I'm telling you is on your decision number one, if you decide to take the plunge into fixed rates, is you got to bite the bullet. You got to be okay with the fact that if you are concerned about affordability, you don't really have a nest egg. There isn't like a future or a backup line of credit. You know, for the last 7 or 8 years, I've been telling people it's better to be proactive than reactive with lines of credit, having a backup emergency fund. And how many people are trying to contact me now to get them, and they can't qualify because the stress test is now 7 or 8% instead of 4. Anyways, my point is, if you don't have a backup plan to ride the wave for the next year and a half, then you need to seriously consider now getting into a fixed rate while they're still sitting at 5%, because that is what you qualified for in recent times, and your budget can handle that within reason. Now, going back to my ranting here on the Bank of Canada, encouraging rates, discouraging spending, this is what they're trying to do, right? If your rate is higher and now your mortgage payment has jumped that much, that's their goal. If you're spending an extra $1,200 on your mortgage payment, guess where you're not spending $1,200 anymore? At the mall, on Netflix, on Crave, all these other things, all these technologies, buying a new Apple Watch, whatever, right? This is the whole point of what they're trying to do. The only way to combat inflation is to increase that mortgage payment. It's that simple. And so the variable rate clients are taking the brunt of that. So that's your first part of your decision in getting into a fixed rate right now, is purely based on you need to determine affordability. Can you afford a mortgage at 6, 7, 8, or 9% if you had to hold out to see what's going on? That's what you need to decide. So that right there might solve your answer. You might jump into a fixed rate right now for the next 5 years. You bite the bullet. Oh crap, interest rates drop to 3 or 4% within that 5-year term. Well, was it the safe decision? Did you lose a little money? Maybe. Did you save money? Maybe. That's what you have to determine, is how conservative you are in that decision. The next step is if you are, and this also ties in with people currently renewing their mortgages, right? Like 5 years ago, your interest rate was 2.6%. You got to put a mortgage in now, and your renewal letter says 5.4, and you're saying, holy crap, my interest rate has doubled. Like, what do I do here? Well, you got to look at affordability. Can you afford the payment in the event that you stayed in a variable rate and things go up another 2%? Can you afford that? That's your answer. So that might solve a lot of challenges for people in the current decision of what they have to do. And you can't look back. Hindsight's 2020. You can't be like, I should have done this, I should have done that. At the end of the day, it's affordability. And if that's what you got to do what you got to do, make it happen. Now, moving on to the variable rate thing. If you have a nest egg, if you have an emergency savings, if you have a buffer, if you have a liquid way to have a fallback in the event that rates keep going up, because they're going to, I assure you of that, for sure another % if not higher, can you weather the storm on a variable rate for the next 12 to 24 months? Because if you can, and you can bite the bullet on that variable rate for the next couple years, then the argument is, when the recession triggers, it is very likely that you will save more money getting into a fixed rate at a lower rate at that time. But no one has that crystal ball either, knowing if those fixed rates come back down to 3, 4, 5%. And so this is the same old story with variable rate customers who have been absolutely killing it for the last 10 years, in the sense that they have had zero risk on their backs for how low variable rates have been. But now they're seeing the other side of that variable rate risk, and how are they going to react to it, right? And history, if you go back to people having mortgages for the last 40 years, will tell you variable rates always win, hands down. You look at the averages of what that rate will be over a 25-year amortization and the projections of those recessions and those inflationary periods, the variable rate will always win. It's just if you can handle the next time period right now to weather that storm for that variable rate, or for that fixed rate to come back down at a later date. Okay, so that really is in a nutshell like what people are dealing with in your outlook, in the sense that You have to determine, can you afford it, or can you sleep at night, bite the bullet and lock it in? And if you can't, or if you can weather the storm, run the data and look at it. Like let's look at this, for example. Let's take a scenario in the Okanagan. The good old days, the average mortgage in the Okanagan was about $400,000. Let's say we don't have any data on this yet. I'm just using a rough estimate based on what happened the last couple of years. Okay, but let's just say the average mortgage. This is really high. I'm going high than what's actually. Let's say it's $650,000. Okay. Let's just go to a simple mortgage calculator. Actually, give me a sec here. Simple mortgage calculator. Let's go 650,000. Okay. Let's say the good old days. What am I doing here? 25-year M. And let's go let's say, you got your mortgage 5 years ago, 2.6%. All right. So 650 grand. Your total payment's $2,944 on a 2.6. Okay, $650,000 mortgage. That's a pretty big mortgage in my opinion for most average people in the Okanagan region. But let's just run with it. I know what you're thinking. There's $1 million houses everywhere, but trust me, a lot of people put a lot of significant cash down on. So you'd be surprised the mortgage rates or balances are quite a bit lower on average. Anyhow, so $2,944. You're coming up for renewal. Okay, your renewal rate is 5.4. Yikes, $3,900. Your mortgage payment jumped $1,000. Okay, you take that term difference, interest paid. Okay, let's go back to so you're at $164,000 in interest over the next 5-year term. Okay, and then let's drop back to your original 2.6, 164 minus 170, 77. So let's say you're about a $90,000 interest difference. 90 grand in interest difference in the next 5 years just because you locked in that 5-year fixed rate. That sucks. But what matters to you most right now? Cash flow or long-term equity? And what I mean by that is, can you weather the storm? Meaning, maybe the rate's 5.4 right now. Okay, you go into a variable rate, currently 4.35. Okay, but let's say it's going to go up another quarter point next week, so you're at 5%. Okay, now you're paying, an extra $800 interest times, 800 times, let's say the next 16 months, a year and a half, 18 months, 14.4. That now, let's say the rate goes up even further. Let's say it's 18 grand in interest difference. Okay, but by the time the recession hits and this rate drops back down to 3.5, you're at 3,200. Okay, so the difference between that was only a $30,000 difference. So 18,000 plus the 33,000, 51,000. That's a big leap from 90 grand. I'm just using rough estimates here. Of course, I'm not getting intrinsic with every single penny, but you get what I'm saying here. Is if you weather the storm and wait for those rates to potentially come back down, you could save $40,000 in interest. Okay, maybe on a 5-year term on that size of a mortgage. But the argument comes down to affordability. Meaning, if you just have to have that payment at 5.4% on a 25-year M at $3,900 instead of 2.6, $2,900. So you're paying another $960 in interest every single month. That sucks. But when you do the math on it, and if you can still afford your payment, and that's just what it is for the next couple or few years, then that's just what you got to do. And that's just where we're at, right? So that's where people will determine how far they're going to go with their risk for reward versus just saying, look, this is where we're at and I gotta do this, okay? Obviously, this is very rough figures. Your mortgage could be quite a bit higher, it could be quite a bit lower, but we see the point on the risk versus reward is what makes sense for you now to make sure that you can weather the storm when things get bad, because it's going to get bad. It will. The next couple years will be tough. Take for example, even based on your stress test and how you qualified for the mortgage originally. Maybe you're self-employed. So do you expect your self-employment income to be as rocking as it's been for the last few years? Maybe things are going to slow down. So projecting those potentials, maybe the fixed rate is the safe way to go to make sure you have a budget to work with to feel comfortable about it. Or you're employed, or your self-employment is a niche situation where you can actually, you're thriving and growth is inevitable. You can weather the storm with that extra cash flow that you have, right? So everybody's situation and circumstance is completely different. I know this video was an insane rant. It was completely unedited, and you probably stopped watching 42 seconds into the video. But I hope that this is just going to give you ways to look outside the box as to what your decision is, not being based on purely the mortgage payment, but also not being based on trying to save every single penny that you've ever had, hoping that you're going to, win with the variable rate at a later date. It really comes down to your risk versus reward or your safety net and what makes sense to you. Of course, all my existing clients or any new clients, I'm more than happy to have these deep one-on-one conversations with each person to really look at your situation, not to make the decision for you, but to help guide you down the path that makes sense based on the numbers presented, so you can at least feel good about it. But if there's any takeaway from this video is everybody's impacted by this. Meaning, just because you got a 1 or 2% rate right now and you're killing it on a fixed rate, congratulations, that's fantastic. But what are you going to do in 3 or 4 years from now to make sure you can still afford your mortgage? That's a very important conversation, and very important for you to budget at a later date for how that's going to work if rates do continue to stay where they are or get worse. Or if you're renewing your mortgage, the days are gone where rates just kept getting better. So making a good decision based on your circumstances, or if you're currently in a variable rate and you're ready to jump off the friggin' bridge because you just don't know what you're going to do here, then you need to just take a moment to relax and look at this from a balanced point of view. Rates are still within the stress test level, meaning you technically qualified for what rates are today. It just sucks because you're paying more interest. So if you bite the bullet and get into a fixed rate, that's okay if that's the decision you make, but what game plan or what strategy can you do to get out of that to make up for those higher interest costs? For example, cutting back on costs in living day to day, canceling your Netflix subscription and sharing it with your cousin next door, right? Like all of these things that if you have to do to reduce your costs, or going to get more work, right? Like going to find a way to generate higher incomes to offset that interest cost. These are the decisions you have to make, right? So thank you for watching. I'm sorry it was a massive rant, but of course, feel free to connect anytime and we can discuss this further for sure.